छोटे सेव मेहरा जी छा गए।
बचा लेना।
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
The Monetary Policy Committee of the Reserve Bank of India has met this week, and by the time you watch this episode of Macro Sutra, you would have known what the decision of the MPC has been, what is the rate increase they would have announced, and what is the general sense of the direction of the economy the MPC sees. But that is not what this episode of Macro Sutra is going to talk to you about. We are going to talk about the Q1 fiscal deficit data and what is the significance of that, what is the Q1 fiscal deficit data going to tell us about the rest of the year for the Indian economy. Hello and welcome. I'm YP Rajesh, managing editor of ThePrint, and I have economist Radhika Pandey with me. Hi Radhika. So like I said, I think our viewers would be expecting us to talk about the MPC, but we are not talking about the MPC or the RBI rate because a lot of it has also been already factored in. It's whether 30 or 40 or 50 basis points. We'll talk about something that is more serious and more insightful here for our viewers. That is the Q1 fiscal deficit. So why are we even focused on Q1 fiscal deficit data, Radhika? What is the significance of this Q1 fiscal deficit? Before we go into the details there.
So we know that the budget comes up with some projections about fiscal deficit for the whole year. What is going to be the tax revenue, expenditures, capital expenditure, and so on for the entire year. So the budget makes some projections. Now we want to know that out of the projections, whatever is the target fixed for, say, fiscal deficit or revenue receipts or tax receipts, where are we at the end of the first quarter, because this data comes out every month. Okay, so the central government's finances data is released by the CGA, which is the Controller General of Accounts, every month. So it's a monthly accounts of the central government finances. They give a broad picture of what is happening to the revenues, the expenditures, and as a share of the full year's budget target, where have the central government reached in terms of the revenues and expenditures. Now, it's not very insightful to look at monthly data, but now when we have a quarterly number, so we can make some sense of where the revenue is headed, how the government is faring on its capital expenditure projections, and so on. Therefore, it is the opportune time to review the quarterly trends in the expenditures, revenues of both the central government and state government to get a sense of where we are heading. And it's a very early indication. We will get to know more as we have the second quarter numbers and third quarter, but it gives an early signal about the revenue and expenditure trends of both central and the state governments.
And like Radhika mentioned, it's not just the central data, it's also the data about state governments. You might remember, our regular viewers might remember that we also did the same thing with inflation data recently, and that gives you a more micro picture of what's happening at the state level. We'll do the same with fiscal deficit data also. But first, what is the overall picture looking like?
So overall picture, if we first talk about the central government, the fiscal deficit of the central government for the first quarter has reached 21% of the full year's target. So for the full year's target, the fiscal deficit is projected at 6.4% of GDP. Out of that, for the first quarter, the fiscal deficit is 21% of the full year target. Now, there has been a lot of concern and discussions around the fact that centre's revenue receipts have been weak in the first quarter. Now, it's very important to disentangle and go one step in detail about what has caused this decline or weak growth in revenues in the first quarter. So just to get a broad picture, the revenues of when you say revenues, it includes tax revenues and non-tax revenues. Similarly, you have capital receipts, which includes things like disinvestments, which includes things like repayment of loans and so on. Now, first talking about the revenues, the revenue account. If we look at the revenue account, the tax revenues have done quite well. So tax revenues have registered a growth of 22% over the corresponding quarter of last year. What has led to the weak performance of revenues overall is due to the non-tax revenue, which is due to lesser than anticipated RBI dividend to the central government. So one is the revenues, which primarily we understand revenues as tax revenues, which includes income tax, corporation tax, excise duties, GST. But there is another component of revenue, which is non-tax revenue, which primarily includes the dividends or the surplus from Reserve Bank of India and other public sector entities. Now, if we may remember, last year the Reserve Bank of India transferred almost 99,000 crore as surplus dividend. This time, the surplus transfer for the previous year, which is accounted for in this year's fiscal data, is around 30,000 crore. So that is one of the main reason for the weak growth of the revenues of the central government. So that's on the revenue side. But the positive side is that the capital expenditure has really done well, and we have been talking about this, that the main plank of government's priority to push the development agenda has been through capital expenditure at a time when private investment is weak. So we see that out of the budget target of 7.5 trillion, central government has already achieved 1.5 trillion rupees. So these are some of the key highlights.
So two questions from there, Radhika. How has the central government managed to spend so much on Capex? Because we know the revenue receipts are down. So where have they managed these funds from?
So revenue receipts are not down, but they are just 5% increase. And within revenue, as I said, there are two parts: tax revenue and non-tax revenue. So the non-tax revenue is down, but your tax revenue has been encouraging. And within tax revenue also, it is your direct taxes like income taxes and corporation tax have done well. Now, if we remember in this quarter, in the month of May, the government also cut excise duties on petrol and diesel. They also had to slash custom duties on palm oil and other edible oils to mitigate the inflation risk. So due to these two factors, the revenues from indirect taxes have been weak, but the revenues from direct taxes have been quite encouraging, and overall tax revenues have been good. So if we just group the revenues of government into tax revenue and non-tax revenue, while non-tax revenue have declined due to lower than anticipated RBI transfer, but tax revenues have done well. And within tax revenues also, it's due to your income tax and corporation tax.
Yeah, I should know. I had to pay more self-assessment tax before the deadline got over. But that's a separate issue. But coming back to the 21% fiscal deficit of the full year target, I mean, if we try and do simple math and say first quarter 21, so does it mean that the trend will remain the same and we might actually do better than the target? Or historically, is there a variation between different quarters?
Very good question. So here, because fiscal
I got excited. It's 21 means it's less than 1/4.
Yeah. So it's a very important thing. Once you look at quarterly figures, for the last years, that can give us some cue about how the quarterly movement we can see in the revenues and expenditures. Normally what happens is that in the first quarter, April to June quarter, in general, the revenues are weak. And coming to the last quarter, January to March, everybody starts paying their taxes. So we see that, 2/3, we see that out of the entire tax revenues, 1/3 happens only in the last quarter. So the substantial jump happens. First quarter is generally a time when tax revenues or revenues as a whole do not pick up much. So just on the basis of this general trend, we can say that government would be able to be quite close to its budget target. The other point is that, in the last 2-3 months, government has done unanticipated spending in addition to its budget. They have increased the subsidies on fertilizer fertilizers. So if you look at the budget, fertilizer subsidies was 1 lakh crore. They have already spent another 1 lakh crore on fertilizer subsidies to cushion the impact. So this question also needs to be connected with inflation. If global inflation headwinds ease going forward, the government's expenditure, which it has to do to mitigate the inflation risk, would be lesser, would come down. And if we look at the initial indications, we do get that picture that there has been cooling of commodity prices, crude oil prices have cooled down. So if this trend continues, then we should see government almost close. If there could be a deviation, that will be quite modest. It won't be too substantial deviation from the budget.
And what is the trend for revenues? I mean, do revenues pick up over subsequent quarters, or do they?
Yeah, so revenues also pick up in subsequent quarters. As I said, first quarter is generally tepid in terms of revenue receipts, and they pick up in second quarter when there's this festive season comes up. So we should see receipts picking up. Even in the current quarter, receipts have been good. The tax revenues have been good, but they are expected to pick up further in the subsequent quarters.
That's the central, fiscal data. What about states? Because like we saw in inflation, we had such surprising numbers from across the country. And reading your piece, which will be in the link will be in the notes or the description of this video. What is the picture for the states?
For states also, we get a very contrasting picture. So first, it is important to know from where we get the states data. So CAG, the Comptroller and Auditor General of India, releases the data on states. And it's not a very, we don't get data for all the states at the same time. For example, as of today, we have data for 21 states for the April to June quarter. For some states, we will have data till April. For some states, we will have only till May. But if we want to get a picture of the quarter, the April to June quarter, we look at for 21 states, which is capturing the overall trend because all the big states are already in there. So if we look at the aggregate picture, and then we can talk about some specific examples. If we look at the aggregate picture, we see that the revenues of states have picked up, which is a very positive feature. One part of it is that, last April to June was the second wave of COVID. The revenues of state governments were quite suppressed. Given that, we have seen that tax revenues particularly of states have picked up in general. Though there are exceptions, and we can talk about those exceptions, but that's one aggregate picture that we are getting, that the tax revenues of states are doing much better as compared to the corresponding quarter of last year.
And what would you attribute that to?
One is that there has been a recovery. There has been services opening up. Also because there has been a lot of transfers from the central government. Central government have also transferred the GST compensation, plus the recovery happening has led to picking up of tax revenues of overall on an aggregate level. The disturbing point is that as what the central government, we see that for the central government, there has been a 57% jump in capital expenditure as compared to the corresponding quarter of last year. But for states, we see on an aggregate level, we see a contraction. That means the receipts, the tax revenues have increased, but they have not been prioritized towards capital spending for most of the states. For most of the states, we see that for this quarter, the first quarter, there has been a decline in capital spending. It may pick up in the coming quarters, and one reason for this is that the central government in its budget announced the rupees 1 lakh crore of interest-free loan, 50-year interest-free loan to states. So central government is doing a lot to incentivize states to pick up Capex, to prioritize their spending towards Capex. So now the budget gave that proposal, and then last month we saw that some rules were framed that out of 1 lakh crore, how you are going to allocate to states. So there we saw that out of that 20,000 crore has already been allocated. So once that money also goes to states, we should see a pickup in capital spending.
You have listed a couple of states in your piece, Radhika, and I will quote from that. Data shows that Bihar's tax receipt were a meager 10.4% of the full year's target, which means they have to make up 90% in the remaining 3 quarters.
Yes.
And states like Gujarat, Karnataka, Maharashtra, Uttarakhand, Telangana and Sikkim have been able to achieve more than 23%, out of which Gujarat, Karnataka, Maharashtra, Uttarakhand have seen fiscal surplus, which means the revenues are higher than expenditure. So should we see it as good, or, I mean, when revenues are higher than expenditure, are these states being conservative when it comes to spending? How do you see that?
So for some of these states, let's first talk about Bihar.
Yeah.
Bihar has seen a contraction in tax revenues plus a contraction in capital spending. So that is one thing. And the other point is that Bihar has seen a very large fiscal deficit. So, the two metrics for talking about the fiscal health of a state is, one is the, tax revenues, how they are faring on tax revenues, how much they have achieved as a percent of full year's target. So as you mentioned, Bihar has achieved only 10%,
10.4.
whereas states like Gujarat, Maharashtra, they have almost touched 1 quarter. So if we say 4 quarters, so it's almost touching 23%.
Yeah.
And these are also the states which are fiscally surplus.
Yeah.
So, one has to see this as a two-dimensional analysis, that you see how their taxes are performing and how their fiscal surplus is looking like. So these are the states which are fiscally prudent. But Bihar is one very is a cause of concern, because they have to one, achieve a higher revenue buoyancy, and the other, they have to spend on capital. So what we infer from this is that whatever expenditure is happening is primarily happening on the revenue side, on revenue expenditure, which includes salaries, pensions, subsidies, and so on. They are not spending too much on capital expenditure. Now, coming to these states which are fiscally surplus, we need to see where they are spending. If they are not spending on capital expenditure, that is not a good thing. So we are just making an early indication that these are the states which are fiscally surplus as at end of first quarter. Now they may have to do market borrowings. They may have to borrow in the coming quarters, and when they do so, they will be in deficit. But as of the first quarter, there are a couple of states, and which is a very unusual thing. Even in the first quarter, we don't see fiscal surplus, but here we are seeing for these states which are doing well on taxation as well as doing well on their overall fiscal deficit.
There are 3 more states which ring a surprising bell: Jharkhand, Odisha and Uttar Pradesh.
Yes, so these are, on one metric, they are doing exceptionally well, and on the other side also they are quite okay. So, we can see these as 3 kinds of, categories. One is kind of states like Maharashtra, Gujarat, Uttarakhand, who have good tax revenues and who are fiscal surplus. Then there are states who may have fiscal surplus, but their tax revenues are not quite good. And then there are states like Bihar who are not performing well on both the metrics.
Last question before I take questions from our viewers, Radhika. So how do states, or how should states, as an economist's view, balance both capex and revenues?
So they have to prioritize their expenditure towards capital expenditure, and the other thing is that the very important metric that they must look at is their interest payments as a share of their revenues, or as a share of their expenditure. Yeah, debt servicing. How much part of their revenue is just going to service debt? If a significant proportion of their revenues are going to service debt, then there is hardly any fiscal space available for capital expenditure. And if there is no space for capital expenditure, you can't expect medium-term growth in such states. So there has to be this analysis sheds light on the fact that for some states, there is a scope for reprioritization of expenditure towards capital expenditure, and also look at raising their revenue receipts, particularly from indirect taxation, to prioritize towards Capex.
In fact, I think we spoke about this earlier. Punjab spends 2/3 or 3/4 on just debt servicing.
Yes.
So where is the money left?
Where is the money left? So these are the states which, and this early warning signal in the form of these quarterly analysis helps us to assess the fiscal health of states and to look at these 4-5 very simple indicators like capital expenditure, the interest payments, the borrowing, that can give us a sense of the fiscal health of states, because we keep talking about central government, but when we talk about the country's vulnerability, we have to look at both central as well as states. We have to talk about the debt to GDP ratio of both central as well as states.
We'll take this question from Mr. Nagraj Pudukottai. It's come to us on Twitter. Thank you for question, Mr. Nagraj. Domestic banks' sovereign debt holdings as a share of total bank assets stands at 29%. What are the implications of this level of government debt to the macroeconomy?
So there are two aspects to this. Firstly is that in our banking regulation landscape, there is a concept called statutory liquidity ratio, which means that banks have to spend some part of their deposits, they have to invest in government securities. So they have to invest 18 to 19% of their deposits, which include both time deposits and demand deposits, in government security. This is called statutory liquidity ratio. Now, what happened during the COVID time and the last year was that because the credit demand was quite muted, banks invested much more than that. So there is a regulatory prescription that you have to at least invest 18% of your deposits in government securities, but banks did more than that because there was no credit demand and they had to invest somewhere. So that's the reason why we see that in India we have banks' investment in government securities almost touching 29%. But from here, we have to see what is going to happen is that now as the credit demand is picking up, we should see some reallocation, banks reducing their investment in government bonds and spending more towards credit. But on a whole, what we have to say is that banks are the prominent lenders to government bonds. Even if we look at, the allocation of who is investing in government bond. In our country, it's primarily the institution, and banks, insurance firms, pension funds, these are the investors. So that's the reason of this allocation. And going forward, we should see now the Reserve Bank has set up this direction where even retail investors can invest. So we should see some decline in banks' investments going forward.
We have a bunch of questions from viewers who haven't shared their names, so I'm sorry. We would like our viewers to share their name when they give their questions. The first one is, we have seen on a month-on-month basis, GST collections are setting new records. Do you think bringing in basic packaged food items like atta, milk, curd, etc. was mainly because of rising fiscal deficit and weakening of rupee against the dollar?
The analysis or the narrative for this is that there was a loophole in the entire tax structure on what is packaged and what is labeled. So that was the reason of this item getting into the tax net, and it was through consensus. It is not that it was only central government or some states who favored. It was through consensus to bring that. The only thing is that the timing was such that at a time when inflation was rising, is rising. So when you bring these items of mass consumption in the GST net, it leads to it pinches more and it leads to higher inflation. But in terms of GST revenue, it's not going to make such a big impact. It will lead to higher revenues, but it's not a very significant revenue item. It's more towards plugging some loopholes in this category.
There is another question, Radhika. I'm not sure if the number here is correct, but I'll anyway go ahead. The government has also been able to save around 68,000 crore in food and fertilizer subsidies in the first quarter. What do you think are the possible reasons for the same? Is this number correct that they saved 68,000 crore on food and fertilizer? They have not
saved. It's that they have not gone overboard in spending on food and fertilizer subsidy on. Within fertilizer, what has happened is that they have spent more on urea subsidy, which is understandable because the prices were rising, so they have spent on that. But even after all this allocations towards subsidies, what we have seen is that we are quite close to what we did last year. It was not that there has been a significant spurt in subsidies allocation to the budget. So on subsidies, we are doing quite well as of now. And if prices go down, we should see more allocation towards capital expenditure and less towards subsidies.
Do you think, looking at the numbers of fiscal deficit, it is the right decision or it was a right decision of the government to revise the target to 6.4 for this FY23, especially considering the kind of international tensions we are seeing?
So the target was revised in the budget, and at that time there was no talk about the Russia-Ukraine war. That happened towards the end of February, and these budgetary targets are in line with what the Finance Commission has put forward. So the Finance Commission has come up with a glide path for what should be the fiscal deficit of both central and state governments for the next 5 years. Finance Commission is set up for a 5-year period, so they have given a glide path, because we know that during the COVID period our fiscal deficit jumped to 9.5%. So we have to now come back to a path of fiscal consolidation gradually, and that is why I think we are moving very gradually. We have moved from, last year our fiscal deficit was 6.7% actual fiscal deficit, and now we are targeting 6.4. So we are moving quite gradually. So, and given the jump in our tax revenues that we are seeing due to better compliance and due to plugging loophole, we should see, unless and until there is another unanticipated shock, we should see us achieving that fiscal consolidation roadmap.
And just imagine, before COVID, the fiscal deficit target would be 3. The 3 number used to be talked about so much. Now we've doubled that.
Yeah, because that time it was part of our FRBM legislation, and now it's, another thing to talk about is that FRBM Act has not been amended to include all these revised targets. But again, the government's defense is that these are uncertain times and we don't want to put anything into the law. But if we see the Finance Commission targets, it's a very, very gradual glide path.
This is force majeure, as they would call it. Last question, Radhika. It's a follow-up to the 6.4% question. If suppose the government is not able to achieve its fiscal deficit target of 6.4% this year, what would be the implications? Can we see an increase in GST rates, an increase in direct taxes in the next budget? If you were presenting the next budget, what would you do if 6.4% is not met?
So, if there's a modest deviation, that is, it's depending on the global headwinds, it is okay. There could be some modest deviations, and that would lead to increase in borrowings, and that would lead to increase in debt of the central government. And if the debt rises, the interest payments rise. That is a point to note. But I don't think this is a time to further raise GST or raise tax rates at a time when consumption is yet to pick up. It's only picking up modestly. So the more rational approach would be to rationalize the tax regime rather than increasing the tax rates.
In fact, the CII president in a press conference in Bangalore earlier this week talked about the need for reducing tax rates. So increasing tax rates doesn't help anyone except people who collect taxes. So on that note, we will conclude this episode of Macro Sutra. Thank you so much for watching. We were very, very glad to see how much you liked our previous episode on recession, and I hope you will continue to watch Macro Sutra, and we will come back next week with a fresh episode. Until then, stay safe and take care.